welcome to Taking Stock for the week ending the 12th of November 2021, where Jacob Simonsen, our Equities Analyst, and myself, Kien, stream to you all things share market. Thanks for joining us once again, Jake.
Great to be on again, Kien.
Well, the key market theme this week has been inflation, and the US economy reported a 0.9% rise in the consumer prices in September, and this led to a 6.2% growth in the annual inflation rate, the largest year-on-year rise since 1990. And bond futures are now pricing in a 25 basis point rise in the Fed funds rate in July. Meanwhile, the RBA has opened its door to raising rates in 2023 once inflation is sustained within its 2 to 3% target band.
And as highlighted in our earlier episodes, rising interest rates from near zero levels tend to have a positive correlation to equity markets, especially during periods of economic recovery. Inflationary pressures can lead to investor fear, but share market volatility should represent opportunity for prudent investors. In our Taking Stock video on the 29th of October, we presented opportunities to navigate an inflation environment. Some of these ideas lie in the gold sector with companies including Newcrest Mining, REA Metals, Alkane Resources, Westgold Resources, and Arius Resources.
Yeah, that's right, Jake. And another industry that tends to benefit from a steady rise in inflation and interest rates are financials, specifically the banks, because there is scope for banks to increase interest rates on their loans. And this improves their net interest margins, which is the difference between the rates they earn on loans versus deposits. And members may want to refer to our Stockroom recording this week where Jake spoke about the banks in detail. Over the last few years, the low rate environment has made it challenging for the banks with their net interest margins under pressure. And this was reflected in the National Australia Bank's result earlier in the week, with its net interest margin down slightly to 1.71%.
Yeah, and this is lower than the interest rate margins generated from Commonwealth Bank and Westpac, although Westpac's result was impacted by a significant rise in costs as reflected by the bank having the highest cost to income ratio. Westpac is now the least profitable bank with an ROE below 10%, and as a result was the only major bank to fail our borderline star growth threshold. These issues mean that it also has the most attractive gross dividend yield out of the majors at 7.7%.
Yeah, that's right. And meanwhile, the highlight from NAB's result was the market share gains it made in the small to medium-sized business loans and mortgage growth, which were above peers. By focusing on its customers and making banking simpler with faster loan approvals and also digitization, NAB has improved its performance and now trades at a lower dividend yield than Westpac and ANZ with its gross dividend yield of 6.5%. And the stock is also expected to go ex-dividend very soon on the 15th of November. So with the bank reporting season over, the key question for investors is which bank should you buy? Well, this would depend on your growth and yield objective and also your risk tolerance as well. Now, if you want to pursue growth at the expense of a lower dividend yield, then stick with Macquarie Group. Meanwhile, those who prefer less volatility should consider Commonwealth Bank, which is the most profitable bank with a more stable earning stream, and this is reflected in its modest gross dividend yield at about 5%.
Yeah, that's right, Kien. But from our perspective, the most attractive price bank is ANZ with a gross dividend yield of 7.3%. We expect ANZ to recover and improve its systems, especially with loan processing times, to win back market share in the coming year. Meanwhile, NAB has the strongest earnings momentum, and this should help support its share price in the short term. Westpac does look cheap, but needs to deal with a number of active risks. For example, it needs to have its expenses under control and stem the losses from its institutional division. Now, turning our attention to other star stock announcements this week, our digital property classified provider REA Group is tracking ahead of expectations as national listings climbed 11%. The result was supported by REA's high margin premium listing product, a price rise, and a buoyant Australian property market. In addition, listings in October continued to accelerate, increasing 16% as lockdown restrictions eased, which bodes well for the first half 22 result. The market outlook remains upbeat with forecasts for FY22 EPS growth of circa 20%.
Yeah, that property market's quite strong, and that buoyant market has also led to a boom in the housing construction sector as well, especially for building materials producer James Hardie. In its first half result, that was in line with expectations, with the company reporting annualized revenue up 10%. The growth was driven by record demand from both home renovators and new home construction as people moved away from the cities. And while cost pressures continue to persist in the form of higher freight and material expenses, the company has been able to improve on its net profit margin from 14% to 15% on the back of cost-cutting initiatives and also product price increases as well. And thus, management were able to upgrade their financial year 22 earnings guidance by 5%, with consensus anticipating full year 22 earnings growth of around 48%.
Yeah, and turning our attention now to the week ahead, Aristocrat Leisure will be reporting their annual result on the 18th of November. Meanwhile, the AGM season is still underway, so please refer to our corporate calendar for a list of stocks that are expected to provide their trading updates. And moving on to technical alerts, for those that are highly trend sensitive, they can use the SD Max or the Stock Doctor Moving Average Crossover. For those that are moderately trend-sensitive investor, they can refer to the SD30 TSR, 30% stop loss/gains from highs or lows. We had several bullish SD Max signals this week, starting with Baby Bunting and REA Group, while Medibank, Suncorp and Westpac turned bearish on the SD Max. Positively, Westgold signaled a re-entry on the SD30 TSR.
This week, we highlight X-Star growth stock Pushpay. The company focuses on cloud-based software for churches, schools, and education sectors to manage donation data and payments. And the company released its interim results with annualized earnings growth up 45% on the back of a 9% rise in processing volumes. Although the numbers look great at face value, if we remove the impact of the acquisition of REA Media, that's a media streaming provider, the total unique customer growth was flat. In addition, Pushpay reported a slowdown in the average donation revenue per user of their core donor management system as COVID adoption drivers such as social distancing subside. As a result, management downgraded earnings guidance by about 3%, but also cited increased wages and staff retention issues. This is leading to negative earnings revisions post the result.
That's right, Kien. But more importantly, we've had to remove the stock from coverage because it failed our Golden Rule 1 assessment, financial health. The reason for this failure was the quadrupling of intangible assets and the use of debt following the acquisition of REA Media. This was difficult to foresee as management did not provide transaction details at the time. This led to the deterioration of the TLTAI, or total liabilities to total tangible asset ratio, which tipped the overall health score into distress. So the key question here is, what should investors do with the stock? Well, the deterioration in the financial health implies that the stock is now at a high risk and a speculative investment. In addition, the limited number of analysts covering the stock and potential negative earnings revision under Golden Rule 3 outlook and active risks suggests that the forward earnings growth profile is unreliable.
Yeah, that's right. It's important to understand that it's not the magnitude of the future earnings growth which tends to dictate share prices, but rather the unexpected change or revisions to those forecasts. And although this is one of the disappointing investments within our Star Growth stock portfolio, investors should note that there will be winners and losers in any portfolio. The key is to minimize your losses and maximize your gains. Hence, it's crucial to have strong risk management practices in place, including being appropriately diversified and cutting losses when the risk to the business is high, in this case, focusing on Golden Rule 1 financial health. The Australian government has pledged $1 billion to invest in low-emission technologies. During the week, we had an interesting question from a member asking how we can use Stock Doctor to look for stock ideas that could benefit from this thematic. Now, Stock Doctor has a powerful stock filter that allows members to quickly and easily screen for certain keywords or sectors that could take advantage of this investment theme. Under the stock filter section, you'll find a list of standard Lincoln screening fields that may help generate ideas if you are after growth or income stocks. However, If you want to zone in on a key thematic, say you want to find stocks that benefit from electric vehicle technology, you can build your own filter. To do this, select business description and type in keywords such as lithium, cobalt, graphite, nickel, zinc, battery or batteries, or even copper. Then you can add in a number of other filters depending on your investment preference. As an example here, we select the following. Business description, we've selected cobalt, financial health rating, strong or satisfactory, a market cap of at least greater than 100 million, an average daily trade, you need liquidity there, greater than 50K, and return on invested capital greater than 0. So it needs to be making money here. The results then show 3 stocks that are financially healthy: IGO, Metals X, and Nickel Mines.
And Kien, you may also wish to refine your search using the Global Industry Classification Standard, or GICS. Navigate to the right-hand pane and first make sure that you deselect the included unclassified. Then select the industries you wish to isolate your search to. On the theme of electric vehicles, we can select utilities, independent power and renewable electricity, then renewable electricity. Then from the filter criteria, you can select all the factors that you are interested in. Here we have chosen financial health, return on invested capital, gross dividend yield, and average daily trade. Once you are happy with your selections, save criteria and then run. You may save the results as a watch list or convert to a CSV file for further analysis.
Yes, Stock Doctor is certainly a powerful tool to help you look for investment ideas. And thanks, Jake, for your insights again.
Again, thanks for having me on, Kien.
Okay, so the key takeaway from today is inflation creates fear and fear leads to share market volatility, but this should provide opportunity. With the bank reporting season over, it is the perfect time to take advantage of this opportunity because banks tend to benefit from a steady rise in interest rates. So too does gold stocks. Also, there will always be winners and losers in any portfolio, so make sure you apply appropriate risk management. One of them is to monitor the financial health of a business because it can change quite quickly, like with Pushpay. Take care and have a happy, healthy, and prosperous week, everyone.